Well, dear students, good morning to you all. Today our topic is subsidiary books. They are also called as subsidiary journals. Subsidiary journals. In the previous classes, we learned journalizing of transactions, posting into ledger accounts, balancing of accounts, and preparing trial balance. Now, we are going to learn about subsidiary books. Subsidiary books. These are also called as subsidiary journals. In accountancy, there are mainly two books. One is journal and second is ledger. Now, the journal book is divided into subsidiary journals. Subsidiary journals. Instead of maintaining one journal, we are maintaining separate books for separate type of transactions. Understanding? Instead of maintaining one book, the book is subdivided into so many books so as to enter a particular type of transactions in those books. Understanding? Now, we are maintaining separate books like purchase book only for credit purchases, sales book only for credit sales, and then purchase returns book, it is also called outward book. Sales returns book is also called inward book. Then, most important, that is cash book. All cash transactions are entered only in the cash book. Next, bills receivable and bills payable book. These we can learn in separate topic, bills of exchange. Bills of exchange. Next and last, journal proper. Well, my dear students, once again, instead of maintaining one journal, we divided into so many books so as to enter a particular type of transactions in that particular book. Understand? Sir, maintaining one journal only is difficult. Why we have to maintain different books? Because when you are maintaining one journal book, all the transactions which are going on in hundreds and thousands, they are all entered in journal. Then automatically the book becomes lengthy. It is not so easy to carry, not so easy to maintain. Not only that, any information, whatever you want to get, the required information, you can't get easily from the journal. Because so many transactions are there. Thousands of transactions are there. How can you get whatever the information you want? So there are all the problems in journal. Not only that, when you are maintaining in journal, suppose we introduced capital in the business, cash account debtor, to capital account, being capital introduced. Being capital introduced. So whenever a transaction happened in journal, we are entering in the form of journal entry. In the form of journal entry. There is a debit aspect. There is a credit aspect. Debit amount and credit amount. And within brackets narration. And then it is underlined. This is all called time. This is all time waste only. Just we received cash in the form of capital, but we are entering in this form. So, to avoid the time waste, so as to get the required information easily, so as to avoid the mistakes which are also called errors in accountancy. But it is called errors in accountancy. To avoid the errors, to get the information easily, to reduce the time waste. Understand? We are maintaining separate books for separate type of transactions. These are called subsidiary books and subsidiary journals. This system is called practical accounting system. What it is called? Practical accounting system. Now, you may get a doubt. Sir, once you are entering in a journal entry, it is time waste. When you are maintaining so many books, automatically the time waste may become more. You may feel, but it will be reduced. How? Try to look at the board. Number 1, for example, purchase book is there. Next one, sales book. Purchase returns book. Sales returns book. First we are learning this 4. Number 1, purchase book, sales book, purchase returns book and sales returns book. This is also called returns out. This is also called returns inward. Well, dear students, all these books are divided into first date column, particulars column, LF column, inward invoice number, details column, and the last one is amount. The same columns are also here in 4 books. But here instead of inward book, here it is called outward invoice number. Outward invoice number. Here, debit note number. Here, credit note number. Same columns are there. But recently 2 more columns are also added, which are called inward GST, inward IGST in this case. Here outward GST and outward IGST. That GST we will discuss in a separate topic. Right now, these are 4 books are there. Purchase book, sales book and purchase returns and sales returns. Now, in these books we are entering only the goods. Goods means the item with which we are regularly doing business. If it is a bookstall, we have to enter here only books purchased or books sold. Understanding? Suppose you purchase furniture, you cannot enter in these books. Furniture is a asset, it is not goods. Only goods are recorded here. Only goods are recorded. Next, only credit transactions are recorded. You purchased goods, immediately you paid cash, that should not be entered in this book, that should be entered in the cash book. Understanding or not? Once again, in these 4 books, we are entering only goods. Goods means the item with which we are regularly doing business. Suppose if it is an electrical shop, whatever you purchased, suppose electrical or electronics, TVs, coolers, fridge, etc. Whatever you purchased, whatever you sold, you can enter. So based on your business, with which item you are doing business, that item only here entered. Assets are not at all recorded. Only goods are recorded. Next, only credit transactions are recorded. Cash transactions are not recorded. Understand? Now, how the time waste is reduced that I am explaining here. Whenever we purchase goods from Ram Lal, just you have to take the date. Today date is 13th. Just you can write down the name from Ram Lal. You can enter the amount directly. Just you are entering the name and amount, that only important. No debit, no credit, no narration, no time waste. Understand? Next, suppose we sold goods to mother-in-law. Date 14, for example, mother-in-law. We sold 10,000 worth of goods we sold, 10,000 cost of goods we sold at 10% discount, for example. 10,000 cost of goods we sold. minus 10% discount. That is equal to 1000. The net amount you can take in outer column, that is in amount column, that is 9000. Well, dear students, once again understanding or not? No problem. Here we are maintaining 4 books: purchase book, sales book, and purchase returns and sales returns. In these books we are entering only goods. Assets are not recorded. We are entering only credit transactions. Cash transactions are not entered. Cash transactions are entered in the cash book. Next, discount. What it is called discount? At the time of buying and selling, if there is any discount is nothing but here the price is reduced. The tag price, listed price, quotation price, whatever the price is there, that price is reduced. That is called trade discount. What it is called? Trade discount. Trade discount at the time of buying and selling of goods. But cash discount is there. That cash discount at the time of receipt or payment of money. That cash discount will be entered in cash book. Trade discount should not be entered in accountancy. No generality for that. Just you have to take the net amount after trade discount. Understanding? Now once again, here we purchased, just we take the name and amount. We sold, we have taken the name and amount. Suppose we purchased one more, 15. We purchased from Ratan Lal. Suppose we purchased 5,000 at a discount of 5%. The net amount is 4,750. Now come here, returns are there. Purchase returns means previously we purchased, now we return. They are going out. That's why it is called returns out. We purchased previously from Ramlal. To that fellow we returned 2,000. To that supplier we returned 2,000. Again take the name. We returned 2,000. Just we have taken the amount. We received returns from mother-in-law. Some mother-in-law. Then you can write down here. Take the date. Write down the name from whom we received goods. And take the amount. When you are taking the amount, the proportionate discount is also to be reduced. Proportionate discount is also reduced. Suppose we received returns half amount, for example. Out of 10,000, half means 5,000. The discount is there, half is equal to 500. Then you can take the net amount 4,500. 4,500. At the end of the month, just you can total them. Here total is 24,750. Here 9,000. Here 2,000. Here 4,500. Well, dear students, once again, last and final look here. We are in the topic subsidiary books. Instead of maintaining one journal, we are maintaining different books for different type of transactions. Maintaining separate books for separate transactions is nothing but the practical accounting system. Practical accounting system. The journal only divided into several books. Ledger is there separately. Ledger is there separately. Okay now? Now, instead of maintaining journal, why we are maintaining separate books? So as to reduce the time waste, to get the information easily. Next, to reduce the books, whenever the books are in small size, not all in one, all the subjects are there in one book, like this. How can you refer the book, how to maintain the book, how to go through the book, how to get the information? It is not so easy. That's why we are maintaining separate books. Understanding? Now, I told you time waste reduced because no debit, no credit, no debit amount, no credit amount, no narration, no underline. Just you are entering the name and amount. In such a way time is reduced. And one more important point is there. It is the journal only. Separate ledger is there. In the ledger book, purchase account is there. Sales account is there. Purchase returns account, sales account, all the accounts are there in the ledger. When you are entering the ledger accounts, suppose purchase account is there. In the purchases account, no need to write down, no need to post individual transactions, just you can transfer the total 24,750 directly. Understanding? In such a way also you reduce the time waste. You avoid the time waste. Isn't it or not? Look here once again. Purchase book is there now. In the purchase book so many transactions are there now. Individual transaction no need to be transferred, no need to be posted in the ledger. Directly you can transfer the total only. In such a way also time waste is avoided. Understanding? Last and final, these are the books 1, 2, 3, 4. Now we explain. In the next, just I am going to explain the cash book. I am going to explain cash book. These books we are maintaining instead of one journal, but separate ledger is there. In that ledger you have to maintain separate accounts. But purchase account, purchase returns account, sales book to sales returns account, this totals directly you can transfer. No need to transfer individual postings in the ledger accounts. In such a way time is saved. Understanding? Please take down. I will go through next cash book. Understanding or not, my dear students? Once again, any problem, please tell me. Well, so far we covered the first 4 books. Now I am going through cash book. Please all of you, the cash book is the most important in the accounting basics, as well as it is helpful for next topics for bank reconciliation statement also. Now, cash book. In the cash book, is a journal and also a ledger. Cash book works as ledger also. Cash is 2 in 1. It is the journal as well as the ledger. That means no separate cash account is maintained in the ledger. Understanding? In the ledger book, purchase account is there, sales account is there, purchase returns account to sales returns account to SAI account to building account, furniture account, all the accounts are maintained in the ledger except cash account. Cash account need not be maintained in the ledger. Why? The cash book works as ledger also. It is the journal and also a ledger. No cash account in ledger. Well, dear students, it is the most important for interviews and even in the objective type of examinations. Cash book works as journal and also a ledger. No cash account in the ledger. All accounts are maintained in the ledger except cash account. Cash account is a real account. Only cash transactions are recorded. Suppose you purchase goods on cash, recorded in the cash book. You purchase goods on credit basis, recorded in the purchase book. Understand? Only cash transactions are recorded. Receipts are debit side. Payments are credit side. Whatever money coming, whenever money is coming, whenever we receive money, it is entered on debit side. Whenever money is going, whenever we pay cash, the payments are on credit side. Payments are on credit side. Understanding? Now, the cash account starts with the opening balance brought down on debit side and ends with the closing balance carried down on credit side. On credit side. It starts with opening balance brought down. Suppose April 1st, 2020, to opening cash balance brought down. Opening balance brought down. Understand? And ends with closing balance carried down on April 30th by closing balance carried down. Well, dear students, once again, cash account is a journal and also a ledger. It is a two-in-one. Journal is there, ledger is there. No separate cash account is maintained in the ledger. It is a real account. SAI is a personal account. Cash is a real account. Receipts are on debits. Only cash transactions are recorded. Whenever cash received, whenever cash paid. Suppose I purchased this furniture. Money not yet paid. I will pay like this. That means it is a credit transaction. Not recorded here. Only cash transactions are recorded. Receipts are entered on debit side. Payments are entered on credit side. It starts with the opening balance brought down on debit side and ends with the closing balance carried down on credit side. Finally, if you balance the account, gives you closing cash balance. Closing cash balance. Understand? And cash account always shows debit balance. Always shows debit balance. Cash account always shows debit balance. What it means? Always debit side is more. When debit side is more, you have to say it is a debit balance. When credit side is more, you have to say it is a credit balance. Debit total always more because whatever we received, we can make payment from the receipts only. From the receipts only. Some may say, you can take loan now. Loan taken means money came now, then only you pay. So cash account always receipt side more than the payments and it always shows debit balance. Understanding? Here, we are entering only cash transactions. Suppose I sold goods. I received sundry receipts. I received interest on investments. So whatever we received, we are entering on debit side. No need to go through double entry system, that is called debit and credit. Just money coming, enter on debit side. When money is going, enter on credit side. No accounting knowledge is required to maintain a cash book. It is very, very simple and easy to maintain. Next, you paid salaries. Buy salaries. Buy rent paid. By general expenses. So whatever the expenses paid, whatever the payments are made, they are all entered on credit side. Now total of debit side. Take it on credit side. Find out the balance. That is called by balance carried down. By balance carried down. Understanding or not? Once again, last and final. Cash book, it is the journal as well as ledger. It is a real account. Only cash transactions are recorded. Receipts are on debit side. Payments are on credit side. Whenever money is coming, enter on debit side. whenever money is going, enter on credit side. It starts with opening balance brought down on debit side and ends with closing balance carried down on credit side. Whenever you balance the account, you are in a position to find out the month-end cash balance, but it is neither profit or loss, nor loss. Next, the cash account always shows debit balance. Understanding? Next, I am going to tell you some important points. Whenever we purchase goods on credit, we will enter in the purchase book. But whenever the goods are purchased on cash basis, that only recorded in the cash book. Why purchases? Understanding? Goods purchased on credit goes to purchase book. Goods purchased on cash goes to cash book. Assets purchased on cash. It goes to cash book by asset purchased. But whenever you purchase on asset on credit basis, that goes to journal proper. It is also most important. Assets purchased on cash, they will be entered in cash book. But assets purchased on credit, they are entered in journal proper. Okay. Now, well, my dear students, the cash book again, there are 4 parts. Simple cash book or general cash book this is. And then double column cash book is there. Additionally, we are adding discount column. Here we are adding separate column for discount. That is called cash discount. Next, one more. We are adding one more column, bank column. Then it is called triple column cash book. When we added one more bank column, it is called triple column cash book. And then separately we are maintaining a petty cash book for petty type transactions. For small amounts, all transactions of small amounts, they are entered in separate book which is called petty cash book and analytical petty cash book. Understanding? So cash book is maintained again in 4 models. Simple cash book, double column cash book, discount is added, triple column cash book, bank column also added, and then last petty cash book. That we will cover in the next class. Okay. Please take down sincerely. And this bills receivable and bills payable, bills receivable and bills payable, we have to learn in separate chapter which is called bills of exchange. So please go through these 4 books we explained already, and we explained the cash book, how to maintain cash book, and what are the important parts to be remembered. Here also columns, there is date column, particulars column, LF column, and amount column. Date, particulars, LF, and amount column. Were dear students following or not? In the next class, what we have to cover? Double column and triple column cash and petty cash. Okay, see you all in the next class.